March 26, 2021, somewhere inside the prime brokerage desks of Credit Suisse and Nomura, phones are ringing, with news that will cost those two banks alone billions of dollars. It wasn't a war. It wasn't even a market crash. It was a series of margin call defaults, triggered by a single-family office most people had never heard of. Stocks you'd never connected to each other, media companies, Chinese education firms, e-vapor company, global investment banks, all collapsed one after the other. Not because anything was wrong with the companies, because one investor was forced to sell everything at once. By the end of this video, you'll understand exactly how that happens and why it can turn one investor's problem into every investor's problem. Before we can understand a margin call, we need to understand margin. And it's actually a simple idea dressed up in complicated language. Let's say you have £10,000 capital. Your broker says, "I'll lend you another $10,000 that you can buy more share." You now control £20,000 worth of stocks. That's margin trading, borrowing money to buy more than you actually own. The appeal is obvious. If your stocks rise 10%, you don't make 10%, you make 20, because you're earning 10% on 20,000, not 10. That's leverage, and in a rising market, it's intoxicating. But leverage is symmetrical. A 10% drop on 20,000 is a £2,000 loss, but you only had 10,000 to begin with. You've just lost 20% of your own money on a 10% market move. Your broker knows this too. So they set a floor, called the maintenance margin. It's the minimum amount of your own equity that must remain in the account at all times. In the US, that's typically 25 to 30%. In practice, many brokers set it higher. And the moment you fall below that floor, the clock starts ticking. Let's walk through a real example with real numbers so you can see exactly how this plays out. You put in £10,000, borrow $10,000, and buy £20,000 worth of stock. Your equity ratio, your share of the total position, is 50%, well above the maintenance requirement. Now the stock drops 30%. Your $20,000 portfolio is now worth $14,000. You still owe the broker $10,000, so your equity is just £4,000, only 28.5% of the portfolio. Still above the minimum, but uncomfortable. Now it drops another 10%, total of 40%. Portfolio is $12,000, but you owe $10,000. Your equity left was $2,000. That's around 16.6% of equity ratio, well below the 25% maintenance requirement. The broker sends a margin call. Now, you have three options. 1. Deposit more cash to bring your equity ratio back above the threshold. 2. Sell some holdings yourself to reduce the size of the position. Or 3. Do nothing, in which case the broker steps in and sells for you, immediately, at whatever the market will bear. That last part is crucial. The broker isn't looking for a good price. They're not timing anything. Their only objective is to reduce their own risk as fast as possible, and that means selling into a falling market, which often makes the price fall further still. For one investor, this is painful but survivable. The real danger is what happens when thousands of investors hit their margin calls at the same moment, because then it's not one person selling into a hole, it's everyone, all at once. And that's when a margin call stops being a personal problem and becomes a free fall. Now, you might be wondering, how does a single individual problem turn into a market-wide catastrophe? To understand it, you need to think about what happens when forced selling meets a falling market. When prices fall, leveraged investors get margin calls. To meet those calls, they sell. That selling adds supply to the market, which pushes prices down further, which triggers margin calls for other leveraged investors, who then sell, which pushes prices down further still. This is the doom loop, and once it starts, it can be almost impossible to stop from the inside. There's a second, subtler problem: fire sale pricing. When a forced seller hits the market, they're not asking, "What's this worth?" They're asking, how quickly can I sell? That distinction matters enormously. Good assets get dumped alongside bad ones. Prices fall below any rational valuation, and that can drag down anyone holding those same assets, even people with no leverage at all. There's also what researchers call correlation contagion. In normal markets, unrelated assets move independently. But during a margin call cascade, they all start moving together, not because anything fundamental has connected them, but because the same investors are selling all of them at once to raise cash. And here's where buyers disappear. When prices are falling unpredictably, when you can't tell if a stock is down because of fundamentals or because some hedge fund is being liquidated, rational buyers step back and wait. Liquidity dries up. The bid-ask spread widens, and prices overshoot fair value wildly to the downside. Now scale this up. When the investors being margin called are large enough, hedge funds with hundreds of billions in leveraged positions, the cascade doesn't just hurt markets, it threatens the banks that lent to them in the first place. Because if the forced sale prices are bad enough, the collateral the bank is holding isn't worth what they thought. And suddenly, a client's problem is the bank's problem.
Margin calls are not rare events reserved for reckless billionaires. They happen constantly, in bull markets and bear markets alike, affecting everyone from retail traders to the world's largest hedge funds. Most are contained. A single investor, a single position, a manageable loss. But occasionally, the conditions align in just the right way, and what begins as one phone call cascades into something that moves the entire market. Which brings us back to where we started. A man alone in a Manhattan apartment, quietly building a $100 billion time bomb that nobody could see coming. Bill Hwang's Archegos was a family office, and during the COVID lockdowns, he holed up in his Manhattan apartment and quietly built one of the most concentrated bets in financial history. His weapon of choice was a contract called a total return swap. The mechanics are straightforward. You pay a bank a fee to place a bet on an asset. If the asset goes up, you pocket all the gains. If it goes down, you absorb all the losses. You never actually own the shares. The bank does, which means your position never shows up on any public filing. Nobody outside the room knows it exists. That invisibility was the whole game. Hwang used these swaps across multiple banks simultaneously to build enormous positions in a handful of stocks, most fatally, Viacom CBS. And because none of his banks could see what the others were holding, each one looked at its own exposure and thought, manageable. Together, Archegos had quietly amassed over $100 billion in leveraged positions. So what lit the fuse? Something almost mundane. On March 22, 2021, Viacom CBS announced it was selling new shares to raise $3 billion for its streaming business. The offering fell short, pulling in only $2.6 billion, and investors read that as a signal of weakness. The stock began to slide. For Hwang, a sliding Viacom CBS wasn't just disappointing, it was existential. As prices fell, margin calls arrived, and his banks, each blind to what the others were holding, began liquidating simultaneously, selling into each other's selling. Credit Suisse lost $5.5 billion. Nomura lost around $2.9 billion. Total damage across all banks, more than $10 billion in under a week. The Archegos losses proved to be one wound too many for Credit Suisse. The 167-year-old bank was acquired by UBS in 2023, effectively ceasing to exist as an independent institution. As for Hwang himself, before the crisis, his personal fortune had reached around $20 billion. According to Bloomberg, it took approximately 48 hours to wipe it out entirely. He was later convicted of fraud and sentenced to 18 years in prison. So if this is such a well-understood problem, why does it keep happening? And what, if anything, actually prevents it? There are real safeguards. Stock exchanges have circuit breakers, automatic trading halts that kick in when prices fall too sharply, too fast. They give the market time to breathe, for buyers to re-enter, for the cascade to lose momentum. In March 2020, U.S. markets triggered those halts 4 times in a single month. Post-2008 regulation, particularly the Dodd-Frank Act in the U.S., introduced stricter limits on broker lending ratios and greater transparency requirements for large derivatives positions. The theory was sound. If regulators could see the leverage, they could manage the risk. But here's the problem. Leverage is creative. It doesn't disappear because one door is closed. It migrates to wherever the rules are lighter. After 2008, it moved into the swap markets that Archegos exploited. Today, analysts point to crypto derivatives markets, private credit funds, and certain corners of the options market as the places where leverage is building up outside easy regulatory view. The margin call itself isn't broken. It's doing exactly what it's designed to do, protecting the broker when a client can't cover their losses. The systemic danger isn't the call, it's the collective scale of leverage that makes thousands of calls land at once. So, next time you see markets drop 5% in a day with no obvious news, no earnings miss, no geopolitical event, check whether leveraged players are being forced to sell. Because sometimes the most powerful force in financial markets isn't fear or greed. It's a phone call from a broker saying your time is up.